There's a name for what you've been doing. Financial behaviorists call it the Frugality Trap. And the reason they call it that, you're going to want to stay with me. Because here's the part that gets me every time I think about it. This trap doesn't catch people who are bad with money. It specifically catches people who are trying. The ones reading budgeting threads at midnight. The ones who made a spreadsheet in January and actually used it for 3 weeks. The ones who made the real, conscious decision to be smarter this year. Those exact people. If you've ever been genuinely frustrated because you're doing all the right things and the savings still aren't there, this is for you. Legally, I gotta say, none of this is financial advice. Personally, I'd say it's just common sense they don't teach you in Econ 101. So, you've been doing the responsible thing. You canceled one of the streaming services, the one you barely used. You switched to store-brand groceries on most things, kept name brand on the stuff that actually matters. You make coffee at home 4 or 5 mornings a week. You bring lunch to work at least twice. You said no to the impulse buy last weekend. And you feel, honestly, pretty good about your financial discipline. Then you check your bank account at the end of the month, and the number is smaller than it should be, much smaller. You do the math in your head. The coffee discipline alone saves you roughly $12 to $15 a week. Over a year, somewhere between $600 and $800. Add the lunch habit, the canceled subscriptions, the resisted impulse buys. You're doing, on paper, somewhere between $1,000 and $1,500 a year worth of deliberate savings moves. But your actual account doesn't reflect that. Not even close. Maybe you're breaking even. Maybe you're a little behind. And you cannot figure out where the gap is. Here's the thing. The gap isn't where you're looking. It never is. Here's what's actually happening. And it runs in 2 separate layers, each one feeding the other. The first layer has an academic name. Economists call it attention allocation. Here's the mechanism. When you make a small saving decision, the coffee, the subscription, the store brand, your brain doesn't just register a small win, it closes a loop. Neurologically, your working memory files the category under handled. This area of your finances is under control. You checked it, you took action, move on, and so you do. You point your attention somewhere else. Which is, by the way, completely rational. Your attention is a finite resource. You can only actively monitor so many things at once. And this is exactly what the system counts on. Because while your attention is pointed at the small, visible stuff, the second layer is running quietly in the background. Banks call it account maintenance revenue. That is the actual term. You can find it in their quarterly earnings reports under non-interest income. Account. Maintenance. Revenue. You know what that is in English? Fees. Let me give you the actual list. Monthly maintenance fee, usually between $5 and $15, waived if you meet certain conditions. Conditions that are surprisingly easy to accidentally unmeet. Minimum balance fee, kicks in when your balance drops below a threshold for even 1 day in the billing period. Out-of-network ATM fee, anywhere from $2.50 to $5 per withdrawal, plus whatever the ATM operator charges on top of that. Wire transfer fee, $15 to $30 per transaction. Paper statement fee, $1 to $3 a month at some banks for the privilege of receiving your own account information by mail. And the one that gets me personally, the account inactivity fee. A charge, actual, legal, real, for not using your money actively enough. Individually invisible. Collectively, the average American bank account holder pays somewhere between $150 and $300 per year in fees they did not consciously choose. $150 to $300. A fee budget, running silently, below your threshold. And here's what I want you to understand about the threshold part, because this is where it gets specifically engineered. Your brain has a cognitive cutoff for attention. Below a certain transaction amount, roughly $8 to $12 for most people, the mental effort of investigating whether a charge is legitimate actually costs more than the charge itself. Your brain does this math automatically. It's not a flaw in you, it's efficient processing. And the people writing your fee structure know exactly where that cutoff sits. They run behavioral research. They test fee structures across millions of accounts. And they set recurring fees just below the threshold where you'd stop and question it. So while you are heroically, genuinely tracking your $12 weekly coffee spend with real discipline, they quietly withdrew $7 in a maintenance fee, $3.50 in ATM charges from that one inconvenient Tuesday, another $12 when your balance dipped for 3 days in March. You saved $60 this month through active effort. You lost $42 through the fee layer. Net result? $18 ahead. One full month of conscious, consistent, deliberate financial discipline. And you are $18 ahead. That is the math that's been frustrating you. And here's where the conventional advice completely fails you. Because you'd think, okay, I found the villain. Switch banks. Get a fee-free account. Problem solved. Right? Right. Here's the deadlock. Switching banks is not actually difficult, but it is slow. Relinking your direct deposit takes 1 to 2 weeks for confirmation and clearance. Relinking every automatic bill payment, rent, utilities, insurance, subscriptions, takes 2 to 4 hours of active work. Finding and canceling every card on file at various services, add another hour. And during the transition, you're managing 2 accounts simultaneously so nothing bounces. For a person working full-time, maybe taking classes, maybe running a side thing, that 4 to 6 hour process has a real cost in mental energy. And banks know this. The term for it is switching inertia. It's a documented, studied consumer behavior pattern that financial institutions actively factor into product design. The switching experience, the forms, the timing delays, the relinking complexity is not accidentally complicated. It is calibrated to be exactly painful enough that most people decide it's not worth it. Not so painful you complain loudly, just painful enough that you stay. But here's what makes the deadlock complete. Because the fee layer is only half of it. The other half runs inside your own head. Behavioral economists call it the licensing effect. Here's how it works. Every small saving you make, every skipped coffee, every store brand choice, every no to the impulse buy, your brain quietly logs a permission credit. Not consciously, but it's there. You have been responsible. You have been disciplined. You have earned the right to let it go. Just this once, just briefly. And then, reliably, somewhere around week 2 or 3 of the month, something happens. Could be a stressful week. Could be a friend's birthday dinner you genuinely want to go to. Could be that thing you've been eyeing for 3 weeks that is finally on sale. And your brain says, you've earned this. And you say yes. And the thing costs more than 3 weeks of coffee savings. Here's the data on this. People who engage in active small-scale frugality behaviors, consciously tracking and cutting small expenses, spend on average between 15 and 40% more on discretionary purchases in the same calendar month than people who make no active small savings decisions at all. 15 to 40% more. Let me say that differently. The act of skipping your coffee Tuesday through Friday statistically increases the probability of a larger unplanned purchase later in the same month. Not despite the discipline, because of it. Your brain counted the skipped coffees as currency, and it spent them. So now you see the full machine. Small savings redirect your attention toward the fee layer's blind spot. The fee layer runs below threshold, extracting between $150 and $300 a year. Simultaneously, the small savings accumulate as permission credits in your internal accounting. The permission credits enable a larger discretionary spend at week 2 or 3. You end the month frustrated, behind on savings, unable to identify why. And the standard advice, track more, cut more, be harder on yourself, makes it worse. More micro-tracking means more permission credits. More permission credits means bigger licensing spends. The conventional approach is a feedback loop that feeds the trap. 3 moves break it. None of them require you to stop buying coffee. Move 1 is the fee audit. Not of what you voluntarily spent, of what was taken. 30 minutes. Pull your last 3 bank statements. Sort transactions by amount, smallest first. Find every charge under $15 that you cannot specifically name a purchase for. Every maintenance fee, every ATM penalty, every paper statement charge. Add them up. Write the annual total. Multiply by 4 if you're looking at 3 months. The average first-time fee audit surfaces between $70 and $200 per year. That number, found in 30 minutes, outperforms 6 months of coffee discipline. Not because the coffee doesn't matter, because your attention wasn't pointed at where the extraction was actually happening. Meet Marcus, 23, works in logistics, makes $44,000 a year. Marcus did the fee audit on a Tuesday night, found a $12 monthly maintenance fee on his checking account. He'd been paying it for 2 years, since the account's promotional free period quietly expired. He never noticed because it hit on the 1st of the month, a low activity date, and it was consistently below his attention threshold. Found an ATM pattern costing him about $3.50 per month. He hits an out-of-network machine near work 2 or 3 times a month because his bank has no branch in that neighborhood. Found a $1.50 paper statement fee on a credit card he opened 2 years ago and barely uses. Total, over $210 per year in fees that he never actively, consciously chose to pay. Move 2 is the single redirect. Here's the psychological counter to the guilt economy. Instead of cutting multiple small things, which creates multiple guilt tokens, you make one conscious redirect, one specific thing, not the one that looks most virtuous from the outside, the one you actually resent, the spend that genuinely returns nothing real to your life. You redirect only that amount to a fund with a specific name, a real goal, emergency buffer, trip fund, something actual with a label. What changes psychologically is this. Instead of accumulating guilt tokens through self-denial, you're building progress markers towards something named and desired. The licensing effect flips direction. The small action now reinforces the goal instead of licensing an escape from discipline. You're not torturing yourself toward an abstraction called saving. You're building something real, with a name on it. Move 3 is friction asymmetry. You can't fully switch banks in one sitting, but you can do 2 things in under 10 minutes. First, open your calendar right now and set one reminder 90 days from today. Label it. Compare bank fees, one alternative. Not switch banks, just compare. Your bank versus one other. That's the only task. Second, take whatever number your fee audit surfaced. Let's say it's $120 a year, $10 a month, and don't budget it. Don't put it in a category. Treat it as found money. The $20 bill in the jacket pocket from last winter, because that is exactly what it is. It was always yours. It was simply being routed somewhere else while your attention was pointed at the coffee. 6 months after the audit, Marcus, he called his bank. One phone call, 15 minutes. Asked about no-fee tier options. His bank has one. It's not on the website's front page, but it exists. Monthly maintenance fee. Gone. He started walking 2 extra blocks to his bank's actual ATM on the days when it's convenient. On the days it's not, he pulls from the out-of-network machine and logs the fee in a found money recovered column rather than a personal failure column. He stopped tracking his daily coffee. Not because coffee is free, because the attention spent tracking it was generating worse returns than the attention he redirected toward the fee layer and the single redirect fund. At the end of month 6, $214 in a fund labeled Japan. No meaningful lifestyle cuts. No guilt economy cycle. No end-of-month math that refuses to add up. Just the quiet extraction stopped running. That's the frugality trap. You don't fall into it because you're reckless. You fall into it because you're careful, in precisely the spots the system needs your attention. So the fee layer can run uninterrupted, below threshold, 12 months a year. The coffee is the decoy. The guilt economy is the permission structure. The fee layer is the mechanism of actual extraction. And conventional financial advice, track more, cut more, be more disciplined, accelerates all 3. The fine print in your account agreement? It was drafted by people who studied behavioral economics specifically so that you wouldn't read it. They know your attention threshold down to the dollar. They priced the fees just below it. And they made the exit just inconvenient enough that the math stops favoring the move. That's not a bug in the system. That is the system, working exactly as designed. For their balance sheet, not yours. Don't let them play you. Listen to what they're actually saying.